Hello, I'm Ross Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at the 7th best-selling fund on the AJ Bell Invest Centre platform at the moment, namely Troy Trojan. The £3.2 billion fund seeks to provide advisors and clients with long-term capital growth and income over the long run in real terms, and we'll come back to the emphasis on real terms shortly. Fund manager Sebastian Lyon looks to achieve this by investing in UK and global equity and fixed income securities, but the mandate permits the use of other funds and money market instruments if he so wishes. The yield's not too fat at just over 0.5%, with dividends paid semi-annually, and the ongoing charge figure, well, it's not the cheapest at 1.05%. Troy Trojan is ISA and SIPP eligible. The fund is very high conviction, with just 20 stock holdings and 7 bond holdings at the moment, although we'll look at asset allocation more fully in a moment. The first graphic shows the geographic mix of holdings, with the US and UK dominant. The second looks at sector allocation, which gives a hint as to what the fund is all about right now and why advisors and clients may be warming to it. Consumer defensives represent the biggest exposure by miles, with a little healthcare and energy thrown in, but no cash is allocated towards industrials or consumer cyclicals, for example. That's a clue that Lyon is focusing on what could be seen as quality defensives and dependability, and the asset allocation then rams home his underlying view of the world. Equities are 38% of the fund, but cash, including UK Treasury bills, is 28%, index-linked bonds 22%, and gold 12%, including 1% to gold miners. Now, to my mind, this explains why advisors and clients may be looking at the fund right now. It's designed to weather a number of potential market scenarios and in some ways resemble the cockroach portfolio designed by Societe Generale strategist Dylan Grice a while back, a topic, by the way, addressed in last week's investment article on the website. Cash in this portfolio provides downside protection and guards against deflation. Gold and gold miners protect against central bank money printing and the prospect of inflation should governments add fiscal stimulus to lavish monetary policy in an attempt to keep their own jobs, let alone help everybody else keep theirs. Index-linked bonds provide some income and further inflation protection should central banks finally succeed by overdoing the stimulus after 7 years of trying and failing. The equity portion, well, that's focused on quality names with good balance sheets, strong cash generation and long-term records of dividend growth. Key holdings include British American Tobacco, Philip Morris, Microsoft, Altria, Sage and Coca-Cola. This potentially provides a further buttress against plunging interest rates and collapsing bond yields as clients and investors cast around for reliable sources of income. In sum, this 4-pot approach is designed with wealth protection as well as wealth creation in mind, and emphasises that Troy Trojan seeks to provide total returns in real terms. The final graphic shows how the fund has done over 10 years. Nominally, steady performance and limited volatility are 2 traits that spring to mind. The large cash, bond or gold elements may not work for everyone, and some may think the positioning is too conservative, with even the equity portion looking pretty stodgy. And despite that, there were still falls in the fund in 2008, albeit a tough year for everyone, and also 2013 when gold fell from favour. So, advisors and clients do need to make sure that Troy Trojan fits with their overall investment strategy, target returns, time horizon and appetite for risk before they commit any capital, even if the fund clearly has its supporters, judging by our recent fund flows. Thank you for watching, and I look forward to seeing you next time.